Coming up, Australia's unemployment rate falls, the US keeps interest rates on hold, and the Chemist Warehouse reverse takeover hits a bit of a snag. We'll have the details next. Your daily 10-minute business and finance news wrap for this Thursday, the 13th of June 2024. The Australian share market rose today by 0.4%. We'll get the details with Henry Jennings from Markets Today. But first to the economy, where Australia's unemployment rate fell from 4.1% in April to 4% in May, but there are signs of a softening labour market, which the RBA will still need to consider. For more, I spoke with Pat Bustamante, Senior Economist at Westpac. Pat, first of all, how would you describe the state of Australia's labour market?
So the labour market is definitely softening now, and we can see that through most of the labour market indicators. So, for instance, if you look at the unemployment rate, even though it ticked down from 4.1 to 4% today, over the last year or so, it's ticked up for 3.5 to 4%. You look at other indicators, such as the number of hours worked, that's basically gone sideways over the last year. And that means that people are working less hours on average. And there are some people, particularly when you look at the younger cohorts and also female-dominated industries, who are reporting higher levels of underemployment. So they would like to work more hours, but at the moment, given the state of the labour market and the softening conditions, are unable to do so. And also, so today's numbers were quite strong when you look at employment growth. So that grew by almost 40,000. But there's been quite a bit of volatility when it comes to employment growth over the last quarter or so. So if you take the average of the last quarter, on average, we've seen about 25,000 new jobs created each month. And when you compare that to the same period last year, it was 55,000. So there's been a clear step down in terms of jobs created, even though we did get a positive outcome today in terms of 40,000 jobs created.
Is it still fair to say, though, that the labour market right now is somewhat tight?
So it depends on, I guess, what period you compare today's labour market to some other period in the past. So compared to, say, the pre-pandemic period, where the unemployment rate was sitting at 5.2%, it is a lot tighter today than what it was back then. But I guess the impulse is that the labour market is loosening. It's become less tight, definitely less tight than when it was 12, 18 months ago. And we see that continuing over the period ahead, given the weakness we've seen in domestic demand and the domestic economy going forward.
Okay, as you mentioned, employment rose by around 40,000 in the month. But given we also saw stats from the ABS today showing that Australia's population grew by 4.2%, net overseas migration almost 550,000 for 2023, are jobs keeping up with population? And what does it mean for the future of the jobs market?
Yeah, that's right. So we did see the ABS also released population numbers today, and we saw over 2023 there was an increase in the population of about 650,000, as you said, and the majority of that was driven by migration, which was up 550,000 over the year. So that just means that the economy needs to create more jobs to ensure that those people who are migrating to Australia actually are able to find jobs and get that work that they need. So in terms of our calculations, so we estimate that on average there'd be an additional 35,000 jobs needed to be created each month in order to keep the unemployment rate as where it is, kind of fixed. What we've seen is that there's been a step down in employment growth. So over the last 3 months, we've seen only about 25,000 jobs created per month. So that dynamic means that basically you have a bit of supply growing a bit more strongly than demand. And that's leading to a bit of loosening in the labour market. And that's why we've seen some of those indicators tick up, such as the unemployment rate, the underemployment rate, the underutilisation rate. That's all been going up. And it's because that supply has been outpacing demand.
Okay, what do you think the RBA then will be thinking about all of this and the implication for interest rates then?
I think this confirms for the RBA that we're on that narrow path. So we have created, jobs growth is still positive, but it's quite low running at, as I said, about 25 per month over the last quarter. And it's, I guess, lower than the equilibrium rate you need to maintain the unemployment rate where it is. So going forward, they probably think that, it's, we're on that narrow path. But demand is not keeping up with supply, so they're probably, consistent with their forecast, they've got the labour market loosening going forward. And the RBA will not only be looking at, I guess, the labour market data that came out today. Last week, we also received the national accounts data, which showed the economy was quite weak when you look at domestic demand. But it also showed that labour costs have started to really slow in Q1. So we only saw, basically, if you look at labour costs and you annualise growth over the last 6 months, it's grown at pre-pandemic levels. So that threat of, I guess, a wage price spiral and cost push pressures leading to inflationary pressures suggests that that's dissipating and labour costs are actually coming down, and that's consistent with the softening in the labour market that we've seen. So our take would be that the Reserve Bank would see this as consistent with where they're expecting the economy to be, and that they think that they're still on the narrow path.
And just wrapping up, what's Westpac's call for where rates will be and where the unemployment rate will go?
So we're expecting the Reserve Bank to cut at least once late this year, and then another few times next year. And we're expecting the unemployment rate to tick up to 4.2% by the end of this year, and then 4.5% by the end of next year.
Pat Bustamante there, Senior Economist at Westpac.
Now, Market Day on the SBS On the Money podcast.
The Australian share market did rise today. The S&P ASX 200 up 0.4%, 7,749. For more, I spoke with Henry Jennings, a portfolio manager at Marcus today. Henry, the US Federal Reserve left interest rates on hold overnight, pointed to just one rate cut this year. But at the same time, we saw official data show that inflation in the US also slowing to 3.5% annually. Run us through it and what it means for the market.
Well, I guess it was a good number in terms of the inflation number, which came out before the Fed meeting. The core inflation, which is really what the Fed looks at, 3.4%, which was pretty much unchanged and the lowest since April 2021. So that was a good thing. And it does show that inflation is slowing, but still a long way, I guess, from that sort of 2 to 3%, or at least the 2%. So the Fed hasn't moved, but they did point to only one rate cut this year, which, given that at the beginning of the year, the market was going for 7, it has been remarkable how the Fed has massaged expectations down. The market's still holding out for 2 rate cuts this year, but the Fed has said 1. But Jerome Powell was quite dovish in his comments after the meeting. So they're leaving the door open for more than 1 rate cut. So the market took that very well. Bond yields came off, and equity markets rose, and of course driven by Apple and Nvidia, which seem to be Teflon stocks. Nothing can stop them, nothing sticks, no bad news. So the US market continues to hit records.
I did keep an eye on the currency markets. The Australian dollar really jumped quite hard following that US rate decision, jumping about the most in a month against the US as a result. Run us through why.
Well, I guess it's really just a question of the differential between interest rates. And it looks like, the US is going to be cutting maybe before we are on the back of those inflation numbers. We did have a jobs number out today as well, which showed, a 4% headline number, which was a little better, I guess, or worse, depending on which way you look at it from the RBA point of view. We do have an RBA meeting next week, and it's all about differentials. It's all about timing in terms of currency movements, in terms of how that interest rate scenario is going to play out in the US, whether they do cut or not, or whether we do cut. The RBA does tend to follow, but I suspect at the moment the RBA will be on hold for maybe longer, perhaps, than the US.
All right, run us through how the share market reacted and which sectors drove it.
Well, in the US, it's just been a case of, standard operating procedure, really. Apple has had a huge run on the back of their Apple Intelligence announcement the other day. Nvidia continues to push higher. over here in our market, technology stocks are doing okay. We did expect commodity shares to do a little bit better today, given we saw commodity rises, but that doesn't seem to have filtered through, except in some of the gold miners. But technology, banks continue to do well here. So in the US, it's technology driving the market. Here, it's the banks driving our market, and we're seeing record highs again in things like CBA and NABs pushing up towards highs as well. So it is a bit of an interesting scenario. We are dominated by the banks in Australia, that's for sure.
Yeah, you mentioned the banks. NAB, a 9-year high today. What do you make of the sector?
Well, I guess to some extent, it's really just a good story. The banks are not really massive growth engine kind of stories, but of course they are very much geared to the housing cycle. The housing market is still very, very buoyant, and that is really helping the banks. And I guess when you look around in our market, they're 30% of the ASX 200, the big four banks. So if you're going to be buying the index, and a lot of overseas players will just buy the futures, that means that the banks do get a big push as well. And given that we've got resources under a little bit of a cloud at the moment with iron ore, with BHP, Rio and Fortescue, it does mean that the money is going towards the banks, which, it's hard to ignore them. They are money-making machines, although they're not exactly growing money-making machines, but certainly very defensive, very great businesses continuing to crank out the profits and the dividends for shareholders.
One corporate story I've been keeping an eye on is this Sigma reverse takeover of Chemist Warehouse. It's potentially one of the biggest deals of the year, right? But it did hit a bit of a snag today. What can you tell us?
Well, it certainly is one of the most innovative deals of the year, that's for sure. Chemist Warehouse has long been mooted as a potential IPO. And instead of doing the normal traditional IPO, they're doing a reverse takeover of Sigma. And of course, Sigma does wholesale pharmacies around the world, also has its own pharmacies as well under the Amcal brand and other brands. So there is a concern with the ACCC that this will concentrate too much power in Chemist Warehouse and Sigma, and that they may really sort of harm their other independent pharmacies to favour Chemist Warehouse in terms of pricing. So clearly the ACCC has some concerns. They are going to be reporting back in early September on this one. So there are some concerns. I don't think they're insurmountable, but they may need to jiggle the deal a little bit and make some concessions to the ACCC to make it palatable.
And finally, where do you see the opportunities for investors at the moment?
Well, I think in our market, certainly when you look at the divergence between the banks and the resources, I know that we seem to have a stuttering resource boom, but I suspect there is some opportunities are starting to emerge in some of these resource stocks. The banks pretty much at record highs, industrials doing relatively okay, but I think really the resources, if you're a contrarian player, that could be the place to start doing a little bit of bargain hunting, but everything else looks quite expensive at the moment, I have to say.
Jennings there from Marcus Today.
This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.